So there are three things that I wish I knew before I ever even placed my first trade, and this video may save you guys years on your trading journey, so listen closely. All right, number one, I wish I realized earlier that currencies are attached to economies, and when those economies are performing well or have certain capital flows or demand for their currency, the currencies will go up in value. It's not specifically just here about the charts. And again, one of the greatest representations of that is the Japanese yen here. As you guys can see, we're having a massive collapse of the Japanese yen. If we go out to a monthly, you guys can see the Japanese yen is at its lowest point in the past, really 30 years. And that's because the Japanese economy is at its lowest point in the past 30 years from a inflationary standpoint. Now, we did just get a big spike in Japanese inflation, but it hasn't been enough basically to really turn this Japanese yen around. So first things first, if the economies are doing poorly, then the currencies will start to do poorly. Now, of course, this isn't an exact science. There are certain times of what's called risk aversion. You have safe haven currencies like the US dollar, like the Swiss franc, and even like the Japanese yen that increase in value even if the economy isn't performing so well. So there are these offshot scenarios that you need to understand, but at the end of the day, when you just look at textbook economics, textbook fundamentals, you can account for those variables as well, as long as you are paying attention and you don't think that trading in capital markets is black and white. Number two is how fast you can grow a portfolio as a discretionary trader, right? So my background was in institutional finance. I worked for an institutional firm here in Atlanta, Georgia for about 3 or 4 years before I left out and became full-time retail, right? How fast those guys grew capital was just very different than as to how fast you truly could grow capital as a retail trader. Now, here's the terrible part about this. The internet will tell you, and random people will tell you, especially back in the day before prop firms, people would tell you that, oh, you could flip an account, right? And now that has slowly kind of basically left the zeitgeist of how people think about trading, and now people go, oh, you can get money from a prop firm, and that can allow you to grow capital quicker rather than flipping an account. Again, yes, we do operate a prop firm here with Top Trader, but if you have the money, $10, $15, $20,000 to start trading with, then you more than likely will be able to be 10 times more nimble than you would with a prop firm who's going to have restrictions, right? So at the end of the day, you want to skew more towards managing your own portfolio and having control of your own capital. And a discretionary trader can grow capital faster than an institution, but not so fast that it's unrealistic and silly, right? And so you can see these moments in time where, like, for instance, last year when Russia invaded Ukraine, our portfolio was growing in the teens on a monthly basis for about 6 months because of the fact that the euro was just sinking, right? So if we go to the euro USD here, you guys can see here that the euro absolutely collapsed last year, and we had a big part of our portfolio, over 60% of our entire portfolio, shorting the euro throughout 2022. That opportunistic event, that catalyst, gave us an opportunity to exceed far beyond what a normal investment portfolio, passively managed fund would ever do, right? Now, how often does Russia-style invasion of Ukraine-style situations happen? Not often, right? But on a quarterly basis, there are definitely situations that you can take advantage of. As I've mentioned to you guys all throughout this year, the Swiss franc has been the single largest trading opportunity, at least the most obvious one for the year of 2023, where you guys can see here the currency looks like a crypto, and then that can be followed up by what we've seen on the US dollar recently in terms of its buy-side move in 2023, and so on and so forth. So anyway, you can grow capital faster as a discretionary trader, but not so fast that you think that you can flip accounts. We're talking easily being able to get in the teens in terms of a percentage return, like 12, 13, 14%. That's not uncommon in the discretionary trading world consistently. Of course, you can have those random months where you can do 30, 40, 50%, but at that point, you're generating so much alpha that if the market went against you in those scenarios, you could easily be down that much. So there might be people in the comments that say, bro, I average 20% a month and all that kind of BS. just ignore that. At the end of the day, it is completely realistic to be able to get into the teens on an annual basis, meandering around the 8 to 12% on the monthly basis. That is totally possible if the market has the opportunities. And last but not least would be Kelly criterion. Kelly criterion is a mathematical formula that is really, really favorable for traders. Most retail traders have no idea what it is, but you guys are about to find out right now. So make sure you guys like the video. Thank you very, very much. All right, so Kelly criterion basically is during heightened times of probability, you weigh more capital. So if you know that something is likely to play out in capital markets, well then you don't do that old retail trader thing of 1 to 2% per trade. No, you know something's happened. You see that probabilistically things are going to play out in your favor. You have a tremendous amount of context as it relates to what's happening in this particular situation. That is a moment where you weigh more capital. Michael Burry back in 2008, when he was doing the Big Short, didn't risk 1 or 2% per trade. He realized that recession style events are black swan events. They only come around once in a decade maybe. So when that scenario comes across your desk, then of course you're going to weigh more capital in that instance. Retail trading is the exact same way. You cannot do this with technical analysis. No matter what they tell you, you can only risk 1 to 2% per trade using technicals because it's just a pattern that you're trying to claim that gives you a situation where your portfolio can grow over time, right? Which again, hey, you know, still studies till this day haven't proven that to be so true. But when it comes to looking at contextual trading strategies, where you're looking at the fundamentals, you get more understanding of the situations happening in different economies, giving you a little bit more leverage to say, hey, this is looking like it's actually going to play out. You can actually see physical things happening in the world that could allude to that. And then there you go. You know, you're right there with an opportunity that you can truly take advantage of. You guys should watch this video. This video discusses how I use technicals to get in on these type of situations. It is going to help you immensely. All right, guys, like the video, subscribe. I'll talk to you guys soon. Peace.